We are joined now by the co-manager of the $17 billion BlackRock World Mining Fund, Catherine Raw. Catherine, thanks very much indeed for joining us. Catherine, we've recently seen the stock market decline has been really dragging down the price-earnings ratios of mining companies, particularly on the FTSE. Why do you think they were so hard hit?
Well, I think it was the expectation that we were going to move into a hard-hit recession. And I think the market was so focused on US and Europe, they forgot to remember that actually the drivers for commodity prices are the emerging markets, and in particular China. So we actually haven't seen the collapse in commodity prices that many had predicted earlier on in the year. The exchange-traded metals have weakened, but things like iron ore, coal are still holding on to the highs that we've seen earlier in the year. And so profitability for the mining companies has really been very strong, and that's why we've seen this de-rating that has occurred in the market.
Well, when you look at the second half of the year for mining companies now, what is your outlook?
Well, I think our outlook is quite positive because expectations are so low. Clearly there are challenges. I don't think we're expecting commodity prices to rally significantly from where we are today. What we're not expecting is a significant decline, and therefore the profit margins and the earnings growth through production growth that we're seeing from the mining companies makes us actually very bullish for the re-rating and therefore outperformance of the mining equities.
Now, you mentioned China there. Obviously the outlook for China's growth is key to that of raw materials. They're very closely interlinked. When you look at the next 2 years for China, what do you see, and therefore what's the read-through for mining companies?
So the focus really has to be on the commodity intensity of use in China. So we're looking at things like fixed asset investment and infrastructure spend. We then have to increasingly focus on domestic consumption and how government spending translates or moves into domestic consumption. I think for the next 2 years, we're relatively confident that things like the low-income housing policy, the railway, the sort of go west policy will continue to see commodity consumption growth. But what we're then looking at, maybe on a 5-year view, is how that matures into a domestic consumption story.
Now, we're seeing Glencore and BHP reporting earnings this week. What are the main themes that investors should be watching for?
I think there'll be a lot of focus on costs and the ability of mining companies to control cost inflation. So what we're seeing is rising labour costs. We're seeing currencies impacting things like strong Aussie dollar. So we're going to want to see some of that profit margin expansion. So are the companies controlling costs and getting the benefit of the higher commodity prices?
Are things as bad as they were at the depths of the global recession? Well, that is what some metals traders are indicating. Just take a look at this chart. This is the MSCI Global Growth Index. Now, you can see where it bottomed out in 2009 and where it's recovered to today. Now I look at what the commodity traders are doing. The red line represents the ratio of industrial to precious metal trades. It's an indicator of how industrial output compares to investor confidence. Now that's because demand for industrial metals is a leading indicator for manufacturing output, whereas precious metals are seen as a haven investment. Well, today that ratio is back to where it was at the nadir of the financial crisis. So is it as bad as the metals market suggests? Well, our guest, Catherine Raw, is still with us. She helps to manage BlackRock's $17 billion World Mining Fund. Catherine, looking at that, it doesn't look very good. I think you've probably got a slightly more optimistic outlook than that, have you?
Yes, I think what that chart highlights is the difference between, very simply put, East and West, which is in the Western world, we're suffering severe financial stress. So that's why people are moving to the gold price as a safe haven, because they can't own the US dollar, they can't own the euro. They're traditional cash, where you would go if you were nervous. But the commodity prices, the industrial commodity prices, are reflecting strength in the emerging market, as we talked about earlier. And so the fact that the ratio of precious metals to industrial metals is low really just highlights the fact that the financial issues that were there in 2008 are still there in 2011. It doesn't really comment on the strength of the Chinese economy, on the Indian economy, on the Brazilian economy.
Now, obviously we've seen that gold price just going up and up. Is there still the best place for investors to put their money if they're looking for a safe haven?
Well, I think it's more that there's a lack of an alternative. You know, if you could give me something else that a government can't influence, can't manipulate, Look at the Swiss franc. The Swiss franc had been seen as a safe haven asset, and then the government came in and tried to artificially weaken the Swiss franc. So really, the gold price is the only vehicle out there which you can own knowing that the governments cannot manipulate. And that's why it's so attractive at the moment.
Now, in terms of managing your own portfolio during all of this volatility, you have made quite big changes in terms of weightings with base metal, precious metals and bulk commodities. What's been your strategy?
I think really we're looking for the things that had the best supply and demand fundamentals. We recognise that there's going to be volatility. We recognise that in the short term we're not very good at predicting what the market is going to do. But what we can predict are those commodities where we can see a strong structural change in demand pattern, but a supply side that is very constrained. And so something like iron ore is a good example of that, where you have infrastructure build out that's driven by urbanisation, but you have infrastructure within countries like Australia, South Africa, Brazil, all struggling to enable you to grow production. And so there you can see a price that over the medium to long term is well supported. Now that means periods like now are great buying opportunities for stocks like Rio Tinto, BHP Billiton, which are your major producers of those commodities. You can't get exposure in the futures market. You can't get direct exposure to those kind of commodities. And therefore, we have to hold strong and actually say, well, in a year's time, we actually see that the market, we'll look back on the markets today and see that this was the best buying opportunity we had.
That's very interesting. Now, if we look at some of those stocks and what they're doing at the moment, is this a time for M&A activity? If they've got cash, what do they do with those assets right now?
Well, it is, and we've seen some of that take place. So very recently, last week, Rio Tinto bid for coal and allied, a thermal coal producer. We've seen BHP Billiton bid for buy Petrohawk out in the US. So those companies that have cash on their balance sheets and have that strength are taking advantage of this market volatility. And actually that is the complete difference this time around compared to 2008. The mining companies have incredibly strong balance sheets, so they're going to be able to take the opportunity in a way that they weren't able to do in 2008. So really, when you look at the valuations today, as long as we don't go into another liquidity crisis like we had in 2008, as long as global trade continues, albeit at a slightly subdued level because of the possibility of a downturn in Europe and the US, really actually things look very, very positive.
There is a danger though, isn't there, in these volatile times of M&A activity just being a little bit too risky. Do you think you will see more of it?
I hope it's measured. I do hope it's measured, because what you don't want is gearing up balance sheets in an environment where you then can't refinance because the banks aren't lending.
Indeed. If we look at some of the other metals, everyone's been focused very heavily on what's happening to the price of gold. Does that mean that silver and platinum are perhaps now undervalued compared to gold, or is there good reason for that?
That's a difficult one, actually, because what's happened recently is that the gold price is now at parity with the platinum price. And so there's a lot of argument that says, well, you should buy platinum because typically it trades above gold. But the things that are driving the gold price are very different to the things that drive the platinum price. Whilst on a 3-year view we are very bullish on platinum, I think in the short term what we're seeing is panic buying, or at least accelerated buying of the gold price that perhaps you shouldn't automatically assume will be translated into the silver price or the platinum price.
Okay, Catherine, well, thank you so much for joining us today.